This is episode 18 with entrepreneur and financial advisor Jason Clevlen.
You may know the destination, but do you know the path to take you there? This is Profits to Wealth. We shorten the time it takes for entrepreneurs to find true success through guided conversations alongside industry elites. We'll cover your commonly asked questions and dive into the skills, tactics, and lessons learned from business professionals who've turned the industry on its head through experience, critical thinking, as well as practical money management. It's time to talk business, money, and freedom with your host, Jack Marino Jr.
Baron Rothschild said, "Buy when there's blood in the streets, even if the blood is your own." Welcome to Profits to Wealth. This is your host, Jack Marino Jr. Today on the show, Jason and I will be discussing recessions and what they mean for you and your money. Jason, there's a word that's been thrown around a lot today, so I thought we'd talk about recessions.
Sounds like a plan, Jack. Definitely a hot topic on the financial media these days.
Sure is. So let's start out by telling listeners, what exactly is a recession?
So, a recession is when you have two consecutive quarters of economic decline. And the technical measure they're looking at is actually a decline in the gross domestic product, the GDP of the US. And so that measures all of the services and goods that are produced. But the best way to think about it is just an economic decline for two consecutive quarters. And generally, you don't know, when you're in it until you're well into it, since it does take two consecutive quarters of decline to be an official recession. And I believe it is the National Bureau of Economic Research that generally makes the announcement, once we're officially in one.
Right. So the economy is, as we record this on March 30th, most likely already in a contraction. It just doesn't get announced till after the fact.
Correct. It takes a little time for them to confirm that the economy has indeed contracted for two quarters of the year. So, yeah, it takes a little while.
So next question would be, how long does an average recession last?
So, there's a wide range when you look back at the previous 12 recessions going back to 1945. So, in the financial world, we often talk about, post World War II financial history. And, looking back over those prior 12 periods of recession, the average length or duration of recession is about 11 months. But you've got some that lasted well over a year, and you've got others that were much shorter. And so, when you average it out, that's where we're coming up with that 11 months.
11 months. That's the average, huh? I think the next GDP release will be towards the end of April. I believe it's 26. So it'd be interesting to see what type of decline that we have. Some are projecting a 25% contraction in GDP, which is remarkable. We were just recovering from the last global scare. We had one in 16, global recession scare in 16. We had one, a scare in the end of 18, which was part of the reason for that sell off. This has just been one for the history books for sure, because it's not only the longest, it was the longest bull cycle, the longest economic cycle. That is assuming it ended, which most people agree that it has ended and we are in a recession. And I think you and I have discussed this in length that we believe that there's no way around that. I mean, at least the first quarter that comes out will definitely be ugly. Just kind of depends on the subsequent quarter, how fast we all get back to work, because as we record this, most people are asked to shelter in place.
Yeah. Something else worth pointing out is the difference between a bull market as well as an economic expansion. And a bull market generally is just referring to the stock market. You get an increase from previous lows of 20% or more, you're in a bull market. And then the bear market is when you get a decline of 20% or more from previous highs. And this was, I believe, the longest bull market on record. And who knew it was going to be a virus that would come along and end that bull market? I mean, we've definitely achieved more than a 20% decline in the S&P 500 from the recent highs that it hit, a little over a month ago. And we've seen things pull back here pretty sharply. But yeah, this is one of those events that you don't see coming and you can't predict, and throws the markets into a tailspin.
Yeah, I'd say it qualifies as a black swan, the unknown unknown. I think everyone was we talked earlier in the year that the markets were very euphoric, and I think most would say the wild card this year was the election, being it the fourth year in election cycle, that was the wild card that would cause usually volatility in the third quarter. Yeah, this just happened very quickly, and the markets these days react positively and negatively very fast. And it's just that's how technology, I mean, the wave of technology, computer trading, algorithmic trading, exchange traded funds, I mean, the list goes on. It's just kind of eye opening, and we're just kind of in awe on how fast things can happen. So speaking of the markets, how does the stock market usually react if there's talk of a recession or some type of black swan that could create a recession?
So I've got some data to share here, and this is all focused on bear markets that occur around recessions. And on average, when we look at the peak of the stock market and compare that to the trough of a recession, the average decline from that peak to trough is 24.8% for the S&P 500. And so, again, that's a range of data. That's the average. So there's been some recessions where that peak to trough. Actually, the 2008 and 9 financial crisis was 51.9 on the S&P 500. So that's one of the bigger ones. And then, looking back at 1945, there was actually a peak to trough recession where it only declined 6.9%. So you've got a wide range of data there, but the average decline is about 24.8%. And we've already eclipsed that in a matter of weeks with this current downturn that we've seen. And kind of speaking to your point earlier, things have moved very quickly with this decline. And as far as measuring back to peaks in the market, this is the quickest 30% decline for the S&P 500 that we've ever seen. And so I think it's worth bringing all that up because yes, the markets have fallen fast, and it's been a shocking decline in the stock market on how quickly things went down. But to put it in perspective, at this point, we may have already seen the bottom in this downturn as far as the stock market's concerned. Now, the stock market is certainly looking out into the future, and investors are trying to predict where things are headed from here. And generally, the market's looking about 6 months in advance. I mean, that's kind of the general rule of thumb, trying to price in where the economy is going, where corporate profits are headed. And as long as the market sees a path toward improvement from where we are today, then it's likely that the recent bottoms that we have seen in the S&P 500 and other indexes could hold. And what might change that would be if you were to see some unexpected negative news develop that would alter, I guess, that thesis. But volatility probably going to continue for a while. But yeah, that's what we've seen in the past. An average decline of 24.8%, and we've already eclipsed that. So we'll see where this one ends up on the spectrum of returns here. But I think it's good just to keep that in mind. It's come down a lot, and you never know when the bottom is in until it's in the rearview mirror. But there's a good chance that the bottom could already be in, or if not, then maybe we're really not too far from it.
Right. The last two peak to trough were wider than, or the retracements were much deeper than the averages. I mean, like you said, over 50% for '08, and the dot com, I believe, was in the 40s. This one, if it bottoms at that around 2200 level, I think wasn't it like 32, 33% peak to trough this time around so
Yeah,
far.
get real close to 35.
Yeah. So it just, and then the last week, of course, we rallied something like 17%. So it's been a wild ride, and not over for sure. So how long, on average, does it take for the stock market to finally bottom?
So looking back at these past 12 declines, these past 12 recessionary declines, the average bottom was actually reached about 45% of the way through the recession. So if the average recession was 11 months, then you're looking at, on average, about 4 to 5 months in. And of course, you never know when you're at 45% of the way through the recession. I think it's worth mentioning that because half the time, the market's bottoming even before getting to that 45% of the way through the recession. So the markets can bottom very quickly. And just because the economy is in recession or heading toward recession doesn't mean that the stock market is going to continue falling and collapsing until the recession is over. So people have to remember that.
Yeah, I mean, a lot of times the economic indicators or data will give you a glimpse into what's going to happen to corporate earnings. And that can kind of send off some yellow and red flags up to say, hey, something's wrong. But because this is different this time, it's a unique situation where you have COVID-19 was the cause of the recession, bear market, and we've never had a virus cause such calamity in the economic from an economic status and from a market standpoint, at least since the early 1900s, potentially what the Spanish flu. But maybe that's why it happened so fast. I know we can speculate all day on that, but you're saying on average, 4 months or so it takes. So the market bottoms before the economic data catches up.
Correct. And that could very well be the case this time. I mean, things went down so rapidly. I mean, we haven't even begun to see what is the economic damage. And you're right, this time is different. We've talked about that quite a bit. Essentially, a switch got flipped off for a number of sectors of the economy that went from doing pretty well to grinding to a complete stop with zero revenue coming in. So that's pretty unprecedented. And so, we know there's already been a lot of layoffs. That's definitely one of the unknowns, moving forward is what type of job loss is going to occur? How quickly will those jobs come back? I mean, at this point, with the relief package that the federal government passed, that Congress passed, there is at least a lot of support in the short run for people who have lost their jobs. So, yeah, generally things can bottom quickly. It does happen oftentimes before it shows up in the economic data. And likewise, the recovery oftentimes in the markets starts happening before it shows up completely in the economic data. And it seems to me this could very well be one of those scenarios where the market went down very quickly from recent highs. It's another data point. On average, the market typically peaks about 13 weeks prior to a recession. And that does not appear to have been the case this time,
No.
since we went from an economy that was doing pretty well to, essentially switching, certain sectors of the economy completely off. So I think there was very, very low lead time into this downturn because of the nature of what caused it. So it stands to reason that, maybe this market bottoms pretty early through this process. Hopefully that's the case.
Yeah, it sure feels like, maybe a bottom has been put in, but as you said, it's early and there's a lot of variables, a lot of unknowns, and of course, the market does not like uncertainty. So the longer we're sheltering in place as we try to flatten the curve, I think the more uncertainty there is, the more layoffs there will probably be, and then more deterioration in economic data and corporate earnings. But anyway, I mean, it's all speculation on if it's a bottom or not. That's no one knows that. Only time will tell. But on average, once the market bottoms in a recession, what happens typically in the S&P 500?
So here's some good news. Generally, when you see sharp declines like this, that is usually followed by a pretty sharp rebound once things turn around. On average, when we look over these past recessions, once the S&P 500 has reached its trough, the average rally in the S&P from that trough all the way till the end of the recession is an increase of 24.2%. So things can go down sharply, but they can also rally back pretty sharply as well. Just as we've seen, over the last week, the market kind of made a bottom, at least a short-term bottom. We don't know. We'll see if that holds, and has rallied, like you said, about 17% over the last 5 trading days. So things can turn around quickly, and that's another thing that investors have to remind themselves is, these prices that we see today probably won't be around for a long time. And, we have to remind ourselves we're long-term investors. The market's going to recover, the economy's, and, everyone's going to get through this downturn, and stock prices can bounce back really fast.
Yeah, I mean, as we've seen the last week, I mean, things can change on a dime, even in the face of a lot of layoffs and really bad economic data. So, yeah, that's what makes this even more challenging. You can't necessarily use an 08 playbook or prior recession playbook just because of what caused this. And the other thing is, good news is the federal government acted really fast versus an '08. And so I think that has helped the speed of so far the bounce off the bottom. And who knows if this will be a V shaped recovery or a W. There's been plenty of cases in the past where you have a W, the last couple, three that I can recall, pretty deep corrections in the market were V shaped. So your guess is as good as mine on that. But I do know, as we talk about all the time, there's a lot of unknowns there, and earnings, corporate earnings, will start up here in the middle of April, and that will be an opportunity for companies to really kind of give you some transparency in what's going on within their business. And I think that will be an opportunity for the markets to really figure out what direction they're going to go up or down. So a trying time could be ahead of us.
Yeah, and we've talked that a lot of it is going to be dependent on, in this particular situation anyway, where things go with this coronavirus outbreak. And if, we start to see data suggesting that the outbreak is improving faster than expected, well, the, stock market's going to do well under that scenario. Or if they announce treatments, anything that can kind of ease the pressure on the economy needing to be shut down, that's going to really help the economy and the stock market bounce back much faster. But on the flip side, if the outbreak lasts longer, the shutdown has to be in place for longer, then, that's going to create some pain for the stock market. And so a lot of this really just depends on the outbreak. I mean, the underlying economy was doing pretty well if not for having to be shut off due to this virus outbreak.
Right. Well, so, we don't know the next direction of the daily move or the weekly move of the markets, but we did put together our own little playbook or financial considerations during a recession. And so we compiled a list. So we want to talk about that for the duration of our episode. So the first thing that we feel like is essential in a recession is to make sure that you have enough liquidity to ride out the storm. So what we're talking about there is your emergency fund or cash reserves. As a rule of thumb, 6 months of expenses in cash would be an adequate cash reserve. But I will say everyone's situation is different. Sometimes you don't need as much, sometimes you need more. And I bet there's a lot of people now that are thankful that they have at a minimum 3 months, just because maybe one person in the household or both have gotten laid off. And obviously that emergency fund can allow you to continue paying your expenses, kind of regroup, develop a new plan, a new strategy if you need to, and then make subsequent changes to your finances to kind of weather the storm.
Right. And I think this is an excellent reminder. And we talk about it a lot with our clients about the importance of a cash reserve, because everybody says, oh, well, if my investments are down, I'm not going to sell. However, it's situations like this when people tend to lose their job, right? You have a recession, companies are struggling, they may have to lay people off. And if you don't have an adequate cash reserve, then you might be forced to sell. And this is not an ideal time to be going in and liquidating investments in the middle of a downturn after the stock market has sold off. So it's important to, hopefully come into this scenario with a healthy amount of cash reserves and liquidity in place. But if for whatever reason you didn't have a good amount of cash reserves, and especially, if you're concerned that you could possibly lose your job, it's really important to start thinking about what can we do to beef up liquidity. And that kind of brings us into the next thing that we think is important, which is to review your spending plan. So if you're in that situation that you don't have enough liquidity and little worried about job security, then now is the time to be looking at any expenses that can be cut, anything that's not important that can be trimmed from the budget, and try to minimize that outflow of cash before the problem arises. See if you can start ramping up any excess, savings or any excess cash flow into your savings account.
Yeah, so make sure you have an emergency fund. That was one. Two is a spending plan, and both of those are essential. Number three is more on the portfolio. And I will say the better prepared you are with one and two, so the emergency fund and having an adequate spending plan, the more likely you're going to be put in a offensive stance versus defensive. And one of the benefits of a recession is from the stock market standpoint, there's a lot of opportunities if you look at it. But let's say the stock market, or this is a once in a decade, or once every 7 or 10 years we have a recession. And typically in a recession, you have those big drawdowns in the financial markets. Well, that's a huge opportunity. So if you're constantly playing defense, right, and having to sell your investable assets to provide yourself with some liquidity, you're always going to be on your back, on your heels. Whereas if you had one and two taken care of, now we don't have as much worry. We don't have to sell. We can actually go on to step three and even four, which is being more offensive. So let's talk about three, which is rebalancing the portfolio. Now, our strategy at Lake Hills Wealth Management is different. We have an active, what we call active passive strategy. So using stocks and exchange traded funds, we actually will tweak our allocation on an as needed basis. And we were fortunate enough to decrease risk, equity, and then go up you get rid of a lot of credit risk in the bond side. So we're doing strategic sales on this equity side and the fixed income side early on. And so that gave us an opportunity to soften the blow on the downside, to reducing that risk, reducing volatility, and reducing losses. Now puts us in an offensive stance where we can put that cash to work. And so that's pretty hard to do. And I'm sure you would agree with me. So I think that at a minimum, you should rebalance your portfolio every 10% or so on the downside. And in doing so, you're going to be selling your winners, at that point, if you've got bonds in the portfolio, depending on what type of bonds, or treasury and high quality bonds, are probably going to hold up really well and actually go positive, where your stocks are going to be down. So you're going to be selling off your winners, which are your bonds, and then buying more of the losers, which are stocks. And so that's at a minimum what you and I would recommend for the listeners to do, is to rebalance every 10% or so.
Exactly. And that's every 10% of decline in, the stock market, the S&P 500. And this decline's been a pretty rapid one. So, it may not have been very easy to go in and do it every 10%. But if you see a decline of over 10%, that's a good time to go and look at rebalancing your portfolio, because like you said, Jack, there's probably some investments if it's a well-diversified portfolio anyway, there should be some investments in there that held up really well, maybe even gained value through this stock market decline. And by rebalancing, that forces you to sell those profits off. So let's say your bond target was 20%, and after your stocks declined by 30%, and your bonds increased in value, maybe now bonds are 30% of your portfolio, depending on what all you were holding. And so you'd sell off 10%, take your profits off of there, and reinvest them in the stock exposure that is now 30% cheaper than it was a month and a half ago. And so you're forcing yourself to sell high and buy low. And that's a really good strategy. And so if you go and you do that rebalance, you sell some bonds high, you buy some stocks low, and then let's say a month later the market's down another 10 or 15%. Hopefully that doesn't happen, but if it is, then you should rebalance again. You've got to have some discipline to do that. And if you do, history has shown that pays off really nicely in the long term. And so that type of strategy is embedded in our investment strategy as well.
Yeah, so that's one thing that you can do. And then the fourth thing is excess money. So maybe you had an outsized amount of cash maybe in your portfolio or even in your emergency fund, and you feel like you got too much. Maybe you had a year's worth of cash reserve and you really just don't need that, even in light of what's happened. You can now again look to be more opportunistic. This again, recessions happen every decade or so. So you don't get an opportunity very often to buy companies that have literally been sometimes cut in half. And so you can purchase those great high quality companies at a very low price. And obviously the folks that did that in '08 did really well.
That's right. And the best deals come when it's the scariest, when it feels like the worst thing you could possibly do is, buy stocks. That's generally when there's the best deals in the stock market. And even if you're just buying an index fund, which is a large part of what we use, putting money to work when the markets have declined by this amount, as long as you're a long-term investor, you should come out really well on making investments today. We don't advocate playing around in the market to invest money this week to take it out next week. I mean, that's too hard. That's a crapshoot. You've got to be thinking long term. And if you're putting money to work for the long term today, that's a good long term strategy.
What's number 5?
Whenever there is softness in the economy, whenever companies are, suddenly their sales dry up, there are generally going to be opportunities to find some deals. So, for example, if you've been putting off buying that new car and you're in a solid position with your cash reserves, now might be a pretty good time to go out and get a deal on that new car you've been waiting for. You're going to get a much better price on big ticket items like that, or really anything. You're out buying today when there's nobody else out there buying. Same thing goes for, especially these days, booking a vacation. Nobody's traveling right now. And if you're booking a vacation for 6 months or a year from now, you're probably going to get a pretty good price on it today. So there's opportunities out there for people who come into these downturns prepared.
Absolutely. Again, it puts you in, instead of that defensive, it puts you in the offensive position where you can take advantage of that. Because if you didn't have cash reserves and emergency fund and your cash flow in order, you're not even going to be able to take advantage of it. So it really makes a huge difference, not only from business owner standpoint, but on the personal side. If you're prepared, you can really, really do wonders for your finances, and not only that, but your mental health during times of turmoil. If you're going into this with prepared and having a plan. So the next thing is, don't make decisions based on emotion. That's a terrible thing to do, because usually the strongest emotion we feel during times like this is fear. And that fear can cause you to hit the sell button, for example. When you see the market's down 5, 6, 7, 8%, those emotions start popping up. Oh my God, what if this goes to zero? Or what if I lose 70% of this? All these different what if scenarios start popping up. And it's really easy to be driven to do something silly. So don't make any decisions based on emotion in good times or bad times. So to make money in the markets, as you've alluded to, is you need to buy low, so when others are fearful, and take profits when others are greedy. So like in the beginning of the year, I mean, actually, even since fourth quarter, we were talking about how lofty and how euphoric things are. And obviously it's like a rubber band. The rubber band can get pulled in one direction or the other so far. And then when it finally releases, it's going to snap back pretty fast and hard the other way. And that's exactly what's happened here. So everyone went from, I want to buy anything and everything, to, I don't want to buy anything, I actually want to sell. So you want to be a contrarian in times like that.
Yeah, the next one I've got is, this one's not going to apply to everybody, but there's definitely some people out there. If you have incentive stock options, so if you work for a company and you've got ISO, which are incentive stock options, now might be a time to consider exercising those. A lot of people, when they exercise ISO options, they will put up some of their own cash to actually purchase the shares with the options. And if you hold those shares for over a year, a lot of that gain will be taxed as a long-term capital gain rather than as ordinary income. Now, there's some other things to consider in there as far as alternative minimum tax when exercising. However, the stock price is probably much lower now than it was. So exercising those options now is going to trigger less AMT or alternative minimum tax. So it's definitely something to take a look at, talk to your accountant about, see if it makes sense to maybe exercise some options at these lower prices so that you can take advantage of the recovery and have a lower tax rate with long-term capital gain rate on that.
Yeah, that's another way to, I guess, in the midst of all the calamity, is look for the silver lining. And so there's always opportunities when faced with an obstacle. You just have to look for it sometimes. That's a good one. The next one is refinancing your mortgage. So obviously, when markets sell off and the economy rolls over and goes into contraction or a recession, typically interest rates decline. And so with that comes an opportunity to refinance your mortgage. So mortgage rates, I know they're pretty volatile these days, but they're still at historical or near historical lows. And so that's a great opportunity if you're going to stay in your home. Obviously, you need to kind of know what your break even analysis is, because when you refinance your mortgage, you do have costs at some point, whether you're rolling it in or you're paying it out of pocket or you're paying a higher interest rate to do it. So, I mean, there's a lot of ways you can do it, but I think you need to kind of at least review, discuss with your accountant, with your financial professional, what your break even looks like and decide if that is a good option for you. But it's definitely something that should be reviewed.
I agree. If you have a mortgage and you're not below 4%, you should definitely be taking a look at whether or not it makes sense to refinance. And it is different for everybody. It depends how long you're going to be in the house. There's a number of things to consider there, but I would say at a minimum, if you don't have a mortgage rate below 4%, definitely that would be something to take a look at right now. And for that matter, any debt, you could look into refinancing pretty much any type of debt to lower interest rates right now. Car loans, business loans, lines of credit, interest rates have dropped dramatically across the board as a result of this downturn in the economy. So now's the time to look into refinancing.
Absolutely. Number 9 is, in the event where you lose your job. Unfortunately, it's sometimes a trying time, but there are opportunities there. So the first thing you want to do is, obviously, while you're looking for your next move, is you want to ideally roll your retirement plan. Maybe it was a 401k or some type of qualified plan. You want to roll that to your individual retirement account or IRA. And the IRA is going to give you, there's no tax consequences for doing that if you do a direct rollover. But, one of the opportunities is that obviously in an IRA, so there's no, like I said, no tax consequences, but you have more investment options. So you can, instead of using whatever's in your retirement plan, maybe it's 10 options or so, you can actually use individual stocks. You can buy exchange traded funds. You can pretty much buy anything you want in the IRA. And that's a huge advantage. And you're in control of that versus the administrator and fiduciaries of the qualified plan.
Yeah, definitely will simplify your life to consolidate retirement accounts into one IRA. It makes it easier, opens up the door to a lot more options as far as how you invest and what you invest in. And, there's some of the rules are a little more lenient as far as withdrawals and tax withholding. And, there's a number of things. So we definitely think that makes a whole lot of sense. And that brings me to number 10. I don't know, Jack, if you had anything else you wanted to add on
No, go ahead.
consolidating an IRA. So the 10th one that we came up with is another, opportunistic action to think about is converting IRAs to Roth IRAs. And the reason you might think about doing that now, and again, this would be something that you'd want to talk with your tax advisor or financial professional about. Investments have gone down for most people quite a bit. And so if you've lost money in an IRA account, if you convert that account, which is now at a lower level, into a Roth IRA, you're paying tax on that lower amount. And then as things recover, you can be recovering those lost assets in a tax-free Roth IRA account. And so that amount would be growing tax-free. So basically, you could recover whatever you lost tax-free in the Roth IRA. Now, there's tax consequences. So whatever dollar amount you convert from IRA to Roth IRA, you have to pay income tax on. However, if this is going to be a year where you're in a lower tax bracket because of losing a job, then you might be have an opportunity there to pay a lower tax rate than you normally would. It's definitely something to think about. It does cost some money to do it because you're going to have to pay tax on that conversion amount. So it definitely helps if you're in a healthy cash position like we talked about before, but certainly something to consider. And I know we have a number of clients that we do some annual IRA to Roth conversions. And so now that things have declined, we're getting more bang for our buck by converting now, taking that money from their IRAs, converting it to their Roths, because it's then going to recover the value tax-free. So that's definitely something we're looking at for our clients right now.
Yeah, that's a good one. So we put together our top 10 financial considerations during recession. Obviously, there's a lot of things that you can do. And I would say the number one thing that you want to do during this time, again, is not be driven by emotion. It's to keep your head right. And I know we've talked about this before, and one of the things that you can do is practice in the morning, a little quiet time, meditation, whatever you want to call it, and just get a little journal out or just think about all the things that you're grateful for. And I think that can set the tone for the day. And then also make sure that you're not overly consuming too much of the news. Stay informed and educated, but don't 24/7 listen to the news, read the news, social media, etc. Log into your account. You can't bombard yourself with all these negative topics, right? Because that sends you in a tailspin. That's actually the worst thing you want to do. Stay educated, but stay positive, because there are silver linings everywhere you go. There's opportunities. You just have to look for them. They're kind of hidden at times.
I agree 100%. I think that's got to be our tip of the week right there, Jack, is keep your head right and, stay positive. I've been asking myself a question constantly through this sell-off in the stock markets. I mean, it's easy to watch the news and to see all the negative things happening and to play out this kind of worst case scenario in your mind about, wow, well, if this happens and well, things are going to get really bad. But usually the worst case scenario is not the way things play out. And so I simply just ask myself the question, what positive news could come out that would totally turn this market around? And is it reasonable to expect that might happen at some point? And for me, it's pretty easy to come up with some positive news scenarios that could really turn this market around. So I think you have to remind yourself that, the news is not going to continue to get worse and worse and worse. At some point, it's going to turn, and it's hard to know when that's going to happen. The headlines are really bad, but at some point it is. And you can easily imagine, some company announcing, effective treatments to help people get out of the hospital faster from this COVID-19 disease. And, that would have a tremendous positive impact on the economy and the stock market and, everyone's psychology and fear level. And I think that's certainly something that's very reasonable that could happen. And, on top of that, maybe the economics aren't going to be as bad as everyone fears. Maybe not as many people lose their job as everyone fears. I mean, we hear some big numbers floated around. So I think you just have to remember, don't focus on the worst case scenario. That's usually not the scenario that plays out.
Yeah, most of the what if scenarios never even come true. So that's excellent advice. So make sure that you have the right mindset. And so hopefully we've given you some really good tips today on how to weather the storm, so to speak. So Jason, as always, it's been fun. Until next time, we'll catch you on the flip side.
All right, we'll see you soon, Jack.
That's all for this episode of Profits to Wealth. But we have more resources available to you on our website. Head over to profitstowealth.com and take our questionnaire to find out how we can provide you with a tailored approach to your entrepreneurial journey. It's available exclusively on profitstowealth.com. Until next time, we look forward to talking business, money, and freedom right here on Profits